So how does a healthcare behemoth lose hundreds of thousands of members, pay a massive $342 million federal fine, actively bleed money on its Medicaid population, and somehow still beat Wall Street's expectations to the tune of nearly $50 billion in revenue?
Yeah, it sounds impossible, right?
It really does. But welcome to this deep dive, because today we are answering that exact question by tearing apart the Q2 2026 earnings transcript for Elevance Health.
And, for anyone holding this stock, or really just watching the healthcare sector in general, Elevance, which, by the way, most people still remember as Anthem.
Yeah.
They are a massive bellwether.
Oh, absolutely.
I mean, we're talking about a company managing the care of nearly 45 million people. So when they release their quarterly numbers, you aren't just getting a corporate update. You are getting a real-time macroeconomic pulse check on the entire American healthcare system.
Right. From government policy all the way down to consumer behavior. And our mission today is to act as your translators. We are taking this dense Wall Street-facing corporate earnings called ticker symbol ELV, and we are breaking it down strictly for you, the retail investor.
Right, because the healthcare industry loves to hide behind, impenetrable acronyms.
Oh, they love it. The acronyms and the complex accounting metrics. So we are going to be highly data forward, but we are officially ditching the financial jargon today.
Yeah, please.
Whenever we hit a wall of corporate speak, we are going to stop, tear it down, and explain the actual mechanics of how this company is generating cash. We want to give you clear, actionable insights into whether this quarter was a genuine win or if management is just very good at masking systemic problems.
And I think the overarching theme of this particular call is tension. There's this massive tension between their incredibly profitable government and commercial insurance segments and then the severe operational headwinds they are facing in their Medicaid business.
Right.
The way management navigated that tension in Q2, well, that is exactly what we need to unpack.
Okay, let's start with the headline data for the second quarter of 2026. Elevance reported an adjusted diluted earnings per share, or EPS, of $7.45.
Which was a beat.
It was a beat, yeah. It exceeded their own internal projections, and on the top line, operating revenue hit $49.8 billion for the quarter.
So that's an increase of 0.8% year over year.
Right, which sounds great, but here is the metric that should immediately make any investor pause. Total medical membership currently sits at 44.9 million people.
Yeah, that's the red flag for a lot of people.
It really is, because that reflects a sequential drop. I mean, they are actively losing members. The transcript attributes this to attrition in Medicaid, their individual ACA businesses, and a known transition of a fee-based customer.
Right. And then, there's the anomaly of the quarter to consider, too. Elevance reported a net below-the-line benefit of 80 cents per share.
We definitely need to talk about that 80 cents.
Yeah. And management explicitly stated that came primarily from valuation adjustments in net investment income.
Okay, hold on. We can't just brush past that membership drop first.
Sorry.
Because if I own shares in like a streaming company, say Netflix, and they report that they lost 1 million subscribers, the stock tanks instantly.
Oh, immediately. Yeah.
Elevance is shedding hundreds of thousands of human bodies from their rosters. So walk me through the math of how fewer people equals nearly $50 billion in revenue. Because on the surface, a shrinking customer base sounds like a collapsing business model.
I mean, it sounds completely counterintuitive until you look at the actual mechanics of risk pool pricing. Elevance isn't charging a flat, $15 a month for a digital product with zero marginal cost.
Right.
The CFO, Mark Kaye, specifically cited higher premium yields and product revenue as the offsets here.
Okay, translate premium yields for us.
Sure. In plain English, a premium yield is simply the amount of revenue you generate per member. Elevance is constantly adjusting the premiums they charge employers and individuals based on the expected medical costs of their risk pool.
So if baseline healthcare costs are rising, which, they absolutely are right now due to inflation and higher utilization.
Exactly. Elevance just raises its premiums to cover those costs and protect its operating margin.
So they are essentially just hiking prices on the remaining members to make up for the ones who left.
Well, it is a bit more nuanced than just a simple price hike. It's really about pricing accuracy. They are ensuring that the premium they collect accurately reflects the medical risk of the person they are actually insuring.
Okay. Hey,
so even though they have fewer human beings on their roster, the people who remain and the employers who sponsor them are paying significantly more per person than they were a year ago.
Got it. So the increase in the price tag per life is outpacing the decrease in the total headcount.
Exactly.
But is that sustainable? I mean, eventually you just price yourself out of the market, right?
And that is exactly where the product revenue comes in. Elevance is no longer just an insurance company collecting premiums.
Right. They have Carelon now.
Yes. They have this massive vertically integrated services arm called Carelon. Carelon runs pharmacies, behavioral health clinics, care delivery networks.
So when an Elevance member goes to a Carelon clinic.
Elevance is essentially paying itself.
Wow.
Yeah. They are generating revenue from selling actual healthcare services and products, keeping the money inside their own corporate ecosystem. That internal capture of healthcare spending is what really helps offset the raw membership drop.
Okay, that definitely explains the revenue resilience. Now let's dig into this 80 cents per share net below the line benefit.
The anomaly.
Yeah. I want to understand exactly where this money came from because 80 cents per share across a company of this size is a massive pile of cash.
It is. So when you look at a corporate income statement, there is this imaginary line that separates operations from everything else.
Okay.
Above that line is your operating income. That's the money you make from your actual core business. For Elevance, that's collecting health premiums and paying out medical claims.
Right. The day-to-day business.
Exactly. Below that line is non-operating income. Elevance, like all major insurers, holds billions of dollars in cash reserves to ensure they can pay future claims. They don't just, put that cash under a mattress.
Right. Invest it.
Right. They invest it in the broader market. And during the second quarter, the broader market performed very well. Their investment portfolio gained significant value.
So it's just a good quarter for the market.
Yeah. That resulted in a sudden, unexpected windfall equivalent to 80 cents for every single share of stock.
So it's literally just stock market gains. It has absolutely nothing to do with their insurance business getting more efficient or anything like that.
Correct. Their corporate treasury department just had a great quarter. It is a non-recurring one-time gain driven by broader macroeconomic factors, not by their actual underwriting performance.
Okay, let's unpack this for a second. Because if you are the CEO, you have a massive choice to make here.
Huge choice.
Finding an 80 cent per share windfall is like, putting on a winter coat you haven't worn in a year and finding a crisp $100 bill in the pocket.
I love that analogy.
Right. You could go out to an expensive dinner, blow the money, and feel great for one night. In corporate terms, that would be letting this 80 cents drop straight to the bottom line, artificially inflating your third quarter earnings to look like an absolute hero to Wall Street.
Yeah, take the quick win.
Exactly. Or you could take that $100 and invest it in a gym membership for your long-term health. Did management just pocket this money to boost their bonus metrics, or did they buy the gym membership?
What's fascinating here is that they bought the gym membership, and they were extremely aggressive about communicating it to everyone.
Oh, really?
Yeah. CEO Gail Boudreaux and CFO Mark Kaye both stated on the call that they are taking this entire 80-cent non-recurring gain and they are reinvesting the exact amount into targeted one-time investments in the second half of 2026.
Wow.
They are deliberately preventing it from padding their ongoing core earnings.
That is an incredibly disciplined move. I mean, what are the actual mechanics of these investments? Where is that cash physically going over the next 6 months?
So they categorize the spend into three main buckets: medical cost management, AI and member engagement, and provider connectivity.
Okay, give me some examples.
Mechanically, they are using this cash to accelerate their data infrastructure. Boudreaux mentioned they are upgrading systems to detect medical cost trends from a lag time of months down to days or even hours.
Oh, that's a game changer.
Huge. They are investing heavily in AI tools to spot when a specific type of outpatient surgery or maybe a new specialty drug is suddenly spiking in cost across a specific region. That way their clinical teams can intervene immediately.
Instead of finding out a year later.
Exactly. And they're also building out digital APIs to make it easier for hospitals to share electronic medical records directly with Elevance's servers, without human intervention.
So if I am a retail investor looking at my portfolio today, what is the actionable takeaway here? Because on the surface, a company taking a massive profit and immediately pre-spending it, so I don't see it in my dividend yield or a stock buyback, that might sound a bit frustrating.
I get that. But it should actually be incredibly reassuring.
Why is that?
Because institutional Wall Street analysts know the difference between core operating growth and a one-time stock market fluctuation. If Elevance tried to pass off that 80 cents as operational success, analysts would just strip it out of their models anyway.
Right, they aren't fooled by it.
Exactly. Furthermore, if they let it hit the bottom line this year, Next year, they would face an impossibly difficult year-over-year comparison when that 80 cents doesn't magically appear again.
Oh, and then the stock would get punished for an earnings miss.
Precisely. By carving it out and reinvesting it into the actual machinery of the business, into AI that will permanently lower their administrative headcount and reduce future medical cost management, is showing they are prioritizing structural longevity over just short-term stock pops.
So they're buffering their success. They are taking lucky money and turning it into structural armor.
That's a great way to put it.
But to understand why they feel the need to build that armor in the first place, we have to look at what's actually generating their core operational cash, and more importantly, why they are bleeding cash. Let's pivot to the specific business segments, starting with the bright spots: Medicare Advantage and the individual ACA market.
Let's look at the data for Medicare Advantage, or MA. Management stated that their MA operating margin is tracking to at least 2% for the full year of 2026.
Which is solid.
Very solid. Furthermore, they announced a major resolution to a lingering regulatory issue. Elevance made a $342 million payment to the Centers for Medicare and Medicaid Services, CMS, in the second quarter.
Okay, $342 million, that's a big check.
Right. And this was to settle a previously identified MA risk adjustment exposure. But crucially, they received written confirmation from CMS that no sanctions will be imposed and the matter is officially closed.
Okay, we absolutely have to translate MA risk adjustment exposure, because handing a $342 million check to the federal government doesn't normally sound like a win.
No, it doesn't.
Explain the mechanics of how Elevance actually gets paid by Medicare and why CMS came after them in the first place.
So to understand risk adjustment, you kind of have to compare it to something like home insurance.
Okay, go on.
If you apply for a standard home insurance policy, you get a baseline rate. But if you document that your house is built directly on a fault line, has a 30-year-old roof, and sits in a flood zone,
the insurance company assumes you are a higher risk and charges you a way higher premium.
Exactly. Now, Medicare Advantage works similarly, but in reverse. The government pays Elevance a flat monthly fee to manage a senior's health care.
Right.
But if Elevance can document that the senior is incredibly sick, say they have diabetes, congestive heart failure, and clinical depression, the government pays Elevance a much higher monthly rate to compensate for that expected risk.
Because sicker patients are naturally going to require more doctor visits, more hospital stays, and way more expensive drugs.
Exactly. And the mechanism they use to document this risk is called HCC coding, or hierarchical condition categories. Every diagnosis a doctor makes has a specific code, and Elevance submits those codes to CMS to justify their monthly payment.
So where does the exposure part come in?
The exposure happens when CMS audits those codes. The government basically looks at the medical charts and says, hey, you billed us for a patient with severe diabetic neuropathy, but the actual medical record only shows standard managed diabetes. You upcoded the risk to get a higher monthly payment.
Ah. So CMS accused them of exaggerating the fault lines in their patients' charts to extract more money from the federal government.
That is the core of most risk adjustment disputes in the industry, yes.
So what does this all mean for an investor? Settling for $342 million means Elevance paid the fine to clear the books without necessarily admitting systemic fraud, right?
Right, and more importantly, without facing federal sanctions.
And if I'm an investor, this is actually a massive relief, because in heavily regulated industries, uncertainty is vastly more expensive than a one-time fine.
Oh, without a doubt.
When you have an open federal investigation hanging over a segment that drives a massive portion of your revenue, institutional money gets incredibly skittish. They assume the absolute worst.
They assume CMS might hit Elevance with a sanction that bans them from enrolling new members during the annual open enrollment period.
Which would be a total death blow to their growth trajectory.
It would freeze them entirely.
So it's like a sports team. Paying the $342 million is like paying for a necessary surgery on your star athlete. The surgery is wildly expensive, and the rehab hurts your cash flow for a quarter. But now you know the athlete can actually play the next season at 100% capacity.
That written confirmation from CMS is literally the doctor's note clearing them to play. It allows management to operate, design new plans, and bid for the 2027 season without the distraction of a federal axe just waiting to fall. It dramatically lowers the stock's risk profile.
Okay, now, regarding their actual MA operations, the CFO mentioned they are doing an intentional portfolio repositioning. He said they are shrinking to grow. Walk me through the mechanics of how you increase your profit margin by willingly giving up market share in Medicare Advantage.
So Medicare Advantage has been incredibly turbulent recently. The government has been tightening the base payment rates, and seniors are just utilizing more health care post-pandemic.
Right, everyone's going to the doctor more.
Elevance's response was not to blindly chase top-line revenue by just adding as many members as possible, regardless of cost. Instead, they analyzed their data and stopped offering unprofitable plan designs in highly competitive counties.
They just walked away.
They literally let those members walk away to competitors.
And what did they focus on instead?
They doubled down on DSNPs.
Okay, what is a DSNP?
That stands for Dual Eligible Special Needs Plans. These are highly specific plans for seniors who are very low income and qualify for both Medicare and Medicaid at the same time.
Okay.
These members have incredibly high acuity, meaning they are very sick and very complex to manage.
But wait, if they are so sick, why does Elevance want them? Doesn't that just mean massive medical bills for the company?
It does mean higher bills. But the government pays significantly higher risk-adjusted rates for DSNP members. And more importantly, this is where Elevance's Carelon services actually shine.
Oh, I see where this is going.
Right. If you have a relatively healthy senior, you just pay their occasional doctor bill. But if you have a complex DSNP member, Carelon can step in. They can send a nurse directly to their home, manage their dozen different prescriptions, and actively intervene to prevent them from ending up in the emergency room.
So by controlling the actual care delivery, they protect that massive premium the government pays them.
Exactly. They also lean heavily into HMO products, which are tighter closed-loop provider networks that give Elevance much more control over the unit cost of care, as opposed to PPO plans where members can essentially go out of network whenever they want.
So they dumped the low-margin, highly competitive business and focused entirely on complex, high-revenue members where their internal tech and care teams can actually manipulate the cost curve.
You got it.
That perfectly explains the 2% margin. Okay, now let's look at the other bright spot. The individual ACA market, or Obamacare.
Right.
Management expects membership to hit at least 1 million by the end of 2026. They noted this favorability is driven by two things: a higher mix of bonds plans, and favorable 2025 CMS risk adjustment results.
Let's take the bronze plan aspect first.
Yeah, the transcript talked a lot about bronze plan seasonality driving their earlier profitability. Explain the mechanics of how a metal tier impacts quarterly earnings.
Sure. The Affordable Care Act categorizes health plans by metal tiers: bronze, silver, gold, and platinum. A bronze plan is the lowest tier.
Right.
It has the lowest monthly premium, which makes it very attractive to consumers who just want basic catastrophic coverage, but it comes with a very high annual deductible.
All right, if I have a bronze plan, I might have like a $7,000 deductible. So if I get an MRI in February, I am paying the full $1,500 cost of that MRI completely out of my own bank account. Elevance pays zero.
Exactly. Now, view that mechanic through the lens of a corporate calendar year. In the first quarter, January through March, and into the second quarter, Elevance's ACA members are going to the doctor and utilizing healthcare.
But they are paying for it themselves.
Right. Because of those high bronze deductibles, the members are paying for almost all of it out of pocket. Elevance is collecting the monthly premiums every single month, but they are paying out very few claims.
Wow, so it looks like they are making a fortune.
Right. Therefore, their medical loss ratio looks fantastic early on, and their profitability in Q1 and Q2 looks astronomically high.
But that has to catch up with them eventually, right? People hit their deductibles.
It does catch up. As the year progresses into Q3 and Q4, members start hitting that $7,000 threshold. Once the deductible is met, Elevance is suddenly on the hook for the bills.
So profitability naturally mechanically dips in the back half of the year as the insurer actually starts paying for the care.
Exactly.
So because their membership mix has shifted heavily toward these high deductible bronze plans, their earnings look incredible in July, but they know a huge wave of expenses is coming in November and December.
Which is exactly why the CFO was so adamant about not extrapolating this early year favorability into their full year guidance.
Okay, so that paranoid prudence applies to the bronze plans. But what about the second factor, the risk adjustment accrual?
Right.
The CFO said they got favorable 2025 risk adjustment results, but they are prudently reestablishing the majority of the prior year favorability in our current year risk adjustment accrual.
Yeah, that's a mouthful.
I really need a translation for that because honestly, it sounds like corporate doublespeak for just hiding money.
It's not hiding money, I promise. It's expectation management.
Oh.
Risk adjustment in the ACA works very similarly to Medicare. The government balances the scales across all insurance companies in a given state. If Elevance happens to attract a pool of members who are much sicker than the state average, the government cuts Elevance a check to compensate them for that outsized risk.
And if they get a healthy pool.
If they attract a pool of young, super healthy people, Elevance actually has to pay into a pool to subsidize the insurers who got stuck with the sick people.
Got it.
It's this incredibly complex, retroactive mathematical formula that takes over a year to actually finalize.
So what happened with the 2025 numbers?
Well, last year, Elevance made an internal actuarial estimate of how much they thought the government owed them for the year 2025. When the final math actually came back from CMS recently, it turned out the government owed them more than Elevance had originally guessed.
Nice.
Yeah, it was a pleasant surprise. It resulted in a really nice bump in revenue for this current quarter as they trued up the accounting.
But the CFO is actively telling analysts not to expect that to happen again.
Correct. Even though they misjudged in their own favor last year, they are purposely assuming that lightning won't strike twice. For their current 2026 accounting estimates, they are deliberately holding back. They are assuming they will absolutely not get a lucky bonus from the government next year.
If you are an investor, you have to love this dynamic. I mean, they are crushing it in MA. They cleared the federal investigation. They're getting surprise checks from the government and the ACA. Their bronze plans are highly profitable right now. And yet, management is refusing to raise their underlying operational guidance based on these specific wins.
They're playing it very safe.
Exactly. By refusing to count their chickens before they hatch, Mark Kaye is building a massive fortress around their Q3 and Q4 earnings. If medical costs suddenly spike late in the year, they have a massive buffer to absorb the blow. If things go right, they just get to report another massive beat.
It is textbook conservative financial management. They are insulating the balance sheet against surprises.
And frankly, they need that insulation right now. Because it is not all sunshine and surprise checks. We have to address the glaring drain on their resources. The segment that absolutely dominated the Q&A portion of this earnings call.
Medicaid.
Medicaid. If Medicare and ACA are the engines driving the stock, Medicaid is currently the anchor dragging it down.
No question. Management explicitly projected that their Medicaid operating margin for 2026 will be roughly negative 1.75%.
A negative 1.75% margin on a multi-billion-dollar book of business is just brutal. They openly referred to 2026 as a margin trough. They are actively bleeding cash here. Why? What is going wrong?
Well, they outlined very specific cost drivers. They are seeing elevated costs in behavioral health, specialty pharmacy, outpatient surgery, and emergency department visits.
So across the board.
Pretty much. The Medicaid population is utilizing the healthcare system at a significantly higher rate and for way more complex issues than Elevance's actuary is modeled for.
Now, they did note that state rate updates, meaning the amount of money the individual state governments pay Elevance to manage these populations, are coming in favorable. They are seeing rate increases at the upper end of the mid-single digits.
Right.
But despite those rate increases, Elevance is taking drastic action. They announced they are completely exiting the Washington, D.C. Medicaid market, and they warned analysts that more market exits are actively being planned over the next 12 to 18 months.
It's a huge shift in strategy.
And to complicate things even further, they are bracing for a major piece of federal legislation in 2027 called the One Big Beautiful Bill Act, or OBBA, which will introduce new community engagement and verification requirements for roughly 20% of their entire Medicaid book.
There's a tremendous amount of operational mechanics to unpack here, starting with why the margin is so negative in the first place. To really understand this Medicaid trough, we have to distinctly separate two industry concepts that often get completely conflated: acuity and utilization.
Break them down for us. What is the mechanical difference?
Acuity refers to the baseline sickness level of a specific member pool. It is a measurement of potential risk.
Okay, can you give me an example?
Imagine you insure 100 people. If 90 of them are young, healthy adults who work construction and play sports, your pool has very low acuity. If 90 of them are managing chronic diabetes, severe asthma, and end-stage renal disease, your pool has very high acuity. The baseline potential for medical costs is exponentially higher.
Got it. And Elevance, along with the rest of the industry, just went through a massive acuity reset in Medicaid, correct? This goes back to the pandemic unwinding.
Exactly. We have to look at the socioeconomic context here. During the pandemic, the federal government paused Medicaid redeterminations.
Meaning nobody got kicked off.
Right. That meant nobody could get kicked off Medicaid, even if they got a new job and their income rose above the poverty line. But when the pandemic emergency officially ended, states started checking eligibility again. That's the unwinding.
And who lost coverage?
The people who lost coverage were overwhelmingly the younger, healthier people who had actually found employment. The people who remained on Medicaid were the poorest, the most vulnerable, and the sickest. So Elevance's baseline acuity spiked dramatically. All the healthy, low-cost people left the risk pool, leaving a concentrated pool of very high-cost members.
Okay, so that explains acuity. The pool got inherently sicker. What about utilization?
Utilization is purely behavioral. It is the frequency with which those members actually interact with the healthcare system. You can have a very sick member, high acuity, who avoids the doctor, forgets to take their medication, and never goes to the hospital. That means they have low utilization and cost the insurer very little in a given month.
Right.
Conversely, you can have a relatively healthy member who runs to the emergency room every single time they have a minor cough, meaning high utilization and high costs.
So how do these two forces explain the negative 1.75% margin right now? Are people just sicker, or are they just going to the doctor more often?
This was the critical insight from the CFO on the call. Mark Kaye explicitly stated that the acuity reset, that massive disruption of healthy people leaving the pool post-pandemic, is mostly over.
Oh, it is.
Yeah. The socioeconomic sorting has already happened. The members leaving Medicaid today look roughly the same health-wise as the members staying. The baseline sickness has stabilized.
So it's not acuity?
No, the current margin drain, the reason they are bleeding cash in Q2 is purely driven by utilization. The members who are currently on the roster are simply choosing to consume more healthcare services.
Just going to the doctor more.
Right. They are seeking more behavioral health therapy. They are filling more expensive specialty drugs, and they're scheduling more outpatient surgeries than any historical models predicted.
Here's where I want to push back on the math here. You mentioned that state rate updates are coming in at the upper end of the mid-single digits. If the states are looking at this data and paying Elevance 5 or 6% more money per member to cover these costs, why is the margin still negative? Why is there a disconnect between the revenue coming in and the claims going out?
The disconnect is caused by the brutal reality of mathematical lag in government contracting.
The lag.
State Medicaid rates are typically adjusted and locked in on an annual basis. A state government actuary looks at historical claims data from, say, 2024, makes a guess about medical inflation for the future, and sets a fixed monthly price for 2026.
But medical costs don't happen annually.
Exactly. They happen daily. When a sudden, unexpected spike in utilization hits, like thousands of members suddenly seeking intense weekly behavioral health therapy in the span of 3 months, Elevance has to pay those claims immediately. The doctors demand payment right then. But Elevance cannot go back to the state government mid-year and demand more premium money. They are locked into the contract. They literally have to wait until the next annual negotiation cycle to present the new data and beg for a higher rate.
So they are caught in this vicious timing mismatch. They are paying 2026 daily medical inflation prices, but they're collecting monthly premiums based on 2024 actuarial guesses.
Precisely. That is exactly why management refers to 2026 as a trough.
Because it has to bounce back.
Right. A trough mathematically implies a bottoming out before a recovery. Elevance is confident that this new, higher utilization data will eventually be baked into the future state rates. Once the state rates catch up to reality, the margin will expand again. But right now, they just have to absorb the lag on their own balance sheet.
Which leads to the most aggressive action they took this quarter. Gail Boudreaux casually mentions they are packing up and leaving the Washington, D.C. Medicaid market entirely.
Just walking away.
And they are evaluating leaving other states over the next 12 to 18 months. If I am an investor looking at a massive healthcare company, is exiting markets a sign of structural weakness? I mean, is this a retreat because their underwriting teams can't figure out how to manage costs?
It is the exact opposite, actually. Exiting unprofitable markets is a signal of highly effective, ruthless capital discipline. You have to remember, Elevance is a for-profit enterprise.
Right.
They have a fiduciary duty to their shareholders to generate a return on invested capital. In Medicaid, you are negotiating directly with state politicians and bureaucrats. And frankly, some states are simply fundamentally unreasonable business partners.
Unreasonable in what way, though?
If a state refuses to acknowledge the mathematical reality of medical inflation, or if a state refuses to raise rates to match the utilization spikes, Elevance is saying, we don't need the top-line revenue badly enough to actively lose money on it.
That's a huge shift for the industry.
It is. For decades, healthcare companies chased top-line revenue growth. They wanted as many covered lives as possible just to show Wall Street they were growing, assuming they could figure out the profit margins later.
Grow at all costs.
Right. Elevance is breaking that paradigm. If Washington, D.C. will not pay actuarially sound rates that cover the true cost of care, a smart company walks away and redeploys that capital elsewhere. It proves to investors that management prioritizes the quality of earnings over the vanity metric of just holding market share.
It's addition by subtraction. By cutting the dead weight, the overall enterprise becomes much healthier and the margins instantly improve.
Exactly.
And that discipline is going to be vital as they navigate the upcoming regulatory hurdles, specifically this OBBA legislation coming in 2027.
Yes, the One Big Beautiful Bill Act.
Let's look at this neutrally, just based on the mechanics outlined in the transcript. The Act introduces new community engagement and verification requirements. What does that actually mean for Elevance operationally?
Mechanically, it adds a significant layer of administrative friction for Medicaid members. Management estimates this will impact about 20% of their total Medicaid book.
Okay, so a fifth of their Medicaid members.
Right. These specific members will now have to mathematically prove to the state that they are working, volunteering, or engaging in community activities to maintain their health insurance eligibility.
That sounds complicated.
It is.
Yeah.
And they will have to submit paperwork to verify this status much, much more frequently.
From a logistical standpoint, that just sounds like a recipe for administrative disaster. You are asking a very vulnerable population to navigate complex bureaucracy just to keep their insurance. Members are inevitably going to fall through the cracks and lose coverage simply because they missed a piece of mail or couldn't access a state website.
It absolutely increases the risk of coverage drops due to administrative friction. But what is critical for investors to note is management's tone regarding the financial impact.
They aren't panicking.
No, they view this as an entirely manageable operational hurdle. They do not foresee it causing a massive chaotic disruption to their risk pools like the post-pandemic unwinding did.
So they are prepared.
Very. They are already deploying capital to prepare their internal IT systems, and they are mobilizing their community outreach teams to help members navigate the new paperwork well in advance. They're treating OBBBA as a known, solvable administrative challenge rather than some existential threat to the business model.
So to summarize the Medicaid situation, yes, it is an anchor on the balance sheet right now. They are bleeding margin because of a behavioral spike in utilization and a mathematical lag in state payments. But management is not sitting idly by hoping it gets better.
Not at all.
They are actively forcing the issue by demanding higher rates. They are ruthlessly abandoning unprofitable markets, and they are preparing their operations for future regulatory friction. They are playing intense defense.
And that defensive posture in Medicaid is entirely subsidized by the fact that they're playing incredibly aggressive offense in their technology and care services division.
Okay, let's follow the money. We talked about that 80-cent windfall earlier and how they are pre-spending it on infrastructure. Where is that cash actually going, and how does it generate a return?
This is where the narrative shifts from Elevance, the traditional insurance company, to Elevance, the integrated, data-driven healthcare platform.
I like the sound of that.
Let's look at the core metrics for this growth engine, which is primarily driven by Carelon. Management highlighted that Carelon is delivering a staggering 10% average savings in behavioral health costs.
10%?
10%. Furthermore, their value-based home care model, called CareBridge, is delivering mid-teens percentage savings on medical costs.
I need to stop you right there because 10% and mid-teen savings in the healthcare industry are astronomical numbers. Usually, if an insurer shaves 1% off a medical trend, they throw a parade.
Yeah, 1% is usually a massive win.
How exactly does an insurance company intervene in behavioral health to save 10% without actually practicing medicine and just flat out denying care? Walk me through the mechanism.
It all comes down to the transition from a fee-for-service model to an integrated predictive model.
Okay.
For decades, a health insurer just acted as a giant passive financial funnel.
Yeah.
You paid the monthly premiums, you went to an independent doctor when you felt sick, the doctor sent Elevance a bill for the service provided, and Elevance paid it. The insurer had zero control over the actual care being delivered. They just processed the paperwork.
Right. They were just a payer reacting to claims.
But by vertically integrating Carelon into their structure, Elevance isn't just paying the bills anymore. They are actively managing the care to prevent the massive bills from occurring in the first place.
So how does that look for behavioral health?
Take that 10% savings. Carelon isn't achieving that by just, denying therapy sessions to people who actually need them.
Right.
They are achieving it through predictive data analytics and early identification. Because, think about it. Elevance sees absolutely everything.
Yeah, they have all the data.
Exactly. They see your pharmacy claims. They see your primary care visits, your lab results. So their AI algorithms are constantly looking for specific triggers.
Give me an example of a trigger.
For example, let's say a member with diabetes suddenly stops filling their prescription for an SSRI antidepressant and simultaneously misses 2 appointments with their endocrinologist.
That's a red flag.
Historically, the insurer wouldn't notice until that member showed up in the emergency room 3 months later with diabetic ketoacidosis and a severe depressive episode, costing the insurer, say, $20,000.
But now
the AI algorithm flags that refill gap instantly. A Carelon social worker or behavioral health specialist proactively calls that member. They find out, the member lost their transportation to the pharmacy.
So it's a logistical issue.
Right. So Carelon arranges for medication delivery and sets up a telehealth therapy appointment for the next day. By spending a few $100s on proactive intervention, they completely prevent the $20,000 emergency room visit. Multiply that mechanism across 45 million members, and that is exactly how you generate a 10% savings in behavioral health.
That is the holy grail of healthcare economics. You are literally generating better human outcomes for less money. And the CareBridge home care model does the same thing.
Exactly. CareBridge operates on a value-based model rather than fee-for-service. In a traditional model, if a very sick senior needs a nurse, a physical therapist, and an oxygen tank at home, 3 different fragmented companies provide ththose services and bill Elevance separately.
And they don't talk to each other.
No, not at all. But CareBridge coordinates all of it centrally. They take responsibility for the total cost of the patient's care. By coordinating it perfectly and using remote monitoring technology, they catch infections early and prevent hospital readmissions. Preventing a single hospital readmission saves tens of thousands of dollars, driving those mid-teens percentage savings.
Okay, so that is the clinical side of the tech engine. Now I want to look at the administrative side. They highlighted their digital infrastructure, specifically the Health OS platform. They are targeting an 80% real-time prior authorization rate. We have to talk about the friction factor here, because this is the single biggest pain point in the entire American medical system.
The friction factor is universally despised by absolutely everyone involved.
If you ask any doctor or any patient what they hate most about dealing with insurance companies, they will say prior authorization. The doctor looks at a patient and says, "You need this specific MRI to see if you have a tumor." The insurance company responds, "Prove it. Have your nursing staff fax us 40 pages of medical history, and our administrative team will review it and get back to you in 2 weeks."
It is maddening.
It delays necessary care for the patient, and it costs medical offices billions of dollars in administrative overhead just to pay staff to sit on hold and fight with insurance companies.
And Elevance fully recognizes that this friction is fundamentally toxic to their business model. If doctors hate working with Elevance because of the administrative burden, those doctors will demand much higher reimbursement rates to compensate for the hassle, or worse, they will just drop out of the Elevance network entirely.
Which makes the insurance product less attractive to consumers.
Exactly.
So how does Health OS mechanically solve this problem? How do you automate 80% of it?
Health OS essentially plugs Elevance's AI directly into the hospital's electronic medical record system, or EMR. Instead of a human nurse at a hospital gathering paperwork, scanning it, and faxing it to a human nurse at Elevance, who then has to read it and manually check it against medical guidelines.
The AI just does it.
The AI handles the entire transaction in milliseconds. When the doctor orders the MRI in their software, the Health OS API instantly scans the patient's digital chart, extracts the relevant diagnostic codes, compares them to Elevance's clinical criteria, and if the criteria are met, it approves the prior authorization in real time.
Wow, in real time.
Letting an 80% automation rate means that 80% of the time, the doctor gets an instant yes on their screen while the patient is still sitting in the exam room.
That is incredible.
This drastically reduces the administrative headcount Elevance needs to employ, permanently lowering their operating costs. But more importantly, it makes Elevance a preferred partner for health systems because dealing with Elevance suddenly costs the hospital less overhead than dealing with competitors.
It's removing the human friction from the system. Now, let's pivot to the commercial side, the insurance they actually sell to corporate employers. The president of their commercial business, Morgan Kendrick, pointed out something fascinating. They have a record pipeline for 2027, and they explicitly noted they are winning back corporate clients who left them 2 or 3 years ago for cheaper alternatives.
Yes, that was a very key detail on the call.
It's like when you leave your favorite local coffee shop because a giant corporate chain opened across the street and offered a cheaper cup of coffee. You go to the chain for a month to save money, but you realize the quality is terrible, the service is slow, and your order is always wrong.
Right.
Eventually, you end up crawling back to the local shop and paying the higher price because you realize the value was there all along. What does it say about Elevance's pricing power that massive corporate employers are returning to them, despite the fact that healthcare premiums are rising aggressively across the board?
It proves a fundamental shift in the commercial market. Cheap and fragmented is losing to comprehensive and integrated.
Yeah.
For a few years, employers were desperate to cut costs, so they tried a piecemeal approach. An employer might hire one traditional insurer to handle medical claims, a different pharmacy benefit manager to handle drugs, and a third tech startup to handle behavioral health, thinking they were getting the absolute lowest unit cost on each individual piece.
But then you have a logistical nightmare in your hands.
Exactly. The disparate systems don't share data. The employee is totally confused about who to call when they need help. And ultimately, the total cost of care actually goes up because the care isn't coordinated at all.
Because physical health impacts mental health, right?
Right. A patient's physical health impacts their mental health, which impacts their medication adherence. Because Elevance bundles their traditional medical insurance with Carelon's pharmacy, behavioral health, and care delivery services, they offer simplicity.
They are a one-stop shop.
They offer a single point of contact, and they offer total cost predictability. Employers who left for the cheaper piecemeal approach experienced the administrative nightmare firsthand, and now they are returning to Elevance, willing to pay a premium for this seamless integration. It proves their value proposition is highly resilient against price competition.
Okay, that brings us to the wonkiest, but arguably the most important financial metric of the day. The CFO called out their days in claims payable. It currently sits at 45.4 days, which is an increase of 2.9 days compared to last year.
Yeah, the flood.
If you are a layman, taking longer to pay your bills sounds like a massive red flag. It sounds like you are struggling with cash flow and stalling your creditors. Why is this a metric Wall Street analysts track so closely, and what does it actually mean for the health of the business?
In the insurance sector, taking longer to pay claims is actually a sign of massive financial leverage and strength.
Okay, walk me through that.
Think about the mechanics of cash flow. Elevance collects billions of dollars in premiums from employers on day one of the month. They're sitting on mountains of cash, right?
When a doctor or hospital submits a claim for a service provided, Elevance doesn't wire them the money instantly. They review the claim, process it, audit it, and eventually pay it out. Days in claims payable measures exactly how long Elevance holds onto that cash before legally having to write the check.
This is the concept of the float.
Exactly. The float is the lifeblood of an insurance company. By extending that time frame to 45.4 days, an increase of almost 3 full days over last year, Elevance is holding on to billions of dollars of other people's money for an extra 72 hours.
If you are looking at your portfolio right now wondering why ELV is a safe harbor during a high interest rate environment, this is exactly why. Walk through what they actually do with that money for those extra 3 days.
They don't let it sit in a checking account. They invest it in short-term, highly liquid instruments. In an environment where interest rates are hovering around 5%, earning yield on billions of dollars for an extra 3 days generates massive pure profit that drops straight to the bottom line.
Just free money.
This dynamic is a primary driver behind their staggering $6 billion in projected operating cash flow for the year. It allows them to earn free money on the float, and it allows them to maintain a highly conservative, heavily fortified financial reserve cushion. It proves they have total control over their balance sheet and the leverage to dictate payment terms to providers.
It is brilliant, ruthless corporate efficiency. They are essentially acting like a bank, using the medical system's money to generate yield before they pay it back out.
No.
So we've seen current data. We've broken down the segmented stories of Medicare Advantage, the ACA, and the utilization trough in Medicaid. We've looked at the tech and cash flow engines driving the commercial and Carelon sides.
We've covered a lot.
Now we need to bring all these disparate threads together and look at the horizon. What is management actually promising the investors for the future?
This is where the rubber meets the road for stock valuation. Let's hit the core guidance numbers that management laid out. For the full year of 2026, Elevance confidently raised their adjusted EPS guidance to at least $27 per share.
A guidance raise in a turbulent environment is always a strong signal.
They also gave analysts a breadcrumb regarding the third quarter seasonality, expecting Q3 to represent about 17% of that revised $27 guidance. But here is the tricky part, the mathematical maneuver that really requires translation.
Okay, what is it?
For modeling purposes, they explicitly told Wall Street analysts to reestablish a 2026 baseline of $26 per share. And then, off of that lower $26 baseline, they are targeting at least 12% adjusted EPS growth for 2027.
Hold on, we need to stop and do the math here. They just raised guidance to $27. They are publicly telling everyone they're going to make $27 per share this year. But then they turn around to the Wall Street analysts building the valuation models and say, when you calculate our growth trajectory for next year, pretend we only made $26 this year.
Yep.
Why on earth would a publicly traded company willingly lower its own baseline and downplay its current earnings power?
Because of everything we discussed earlier regarding that 80-cent windfall, it goes back to expectation management and strict intellectual honesty. Management is forcing Wall Street to look at the structural reality of the business, not just the headline noise.
Right.
If you recall, Elevance had that 80-cent non-recurring investment windfall from the stock market. They also had 75 cents of original baseline investment spend that was already baked into their earlier projections.
Okay, so they're stripping that out.
Management is looking at the analysts and saying, look, we technically made $27 this year, but a large chunk of that was a one-time lucky break in our investment portfolio, and another chunk was dedicated capital expenditure. If you build your models demanding that we grow 12% off of the artificially high $27 number, you are setting us up to fail next year when the stock market windfall doesn't repeat.
So by stripping out the noise and reestablishing the baseline at $26, they keep analyst expectations grounded. They are ensuring that the 2027 growth target is based entirely on the core operations of selling insurance and delivering care, not on the hope of another stock market rally.
Exactly. It prevents a massive sell-off next year caused by an unrealistic year-over-year comparison. But even with that lowered baseline, promising at least 12% adjusted EPS growth for the following year is a massive, aggressive statement of confidence.
Which begs the question, how confident does a management team have to be to project double-digit earnings growth a year and a half into the future? I mean, we just spent 20 minutes talking about how Medicaid is bleeding cash in a margin trough. We talked about the OBBA legislation looming in 2027. Yep. We talked about medical utilization spiking.
There are a lot of headwinds.
Right. So if I am a skeptical retail investor, my immediate question is, does this 12% growth projection rely on Medicaid magically fixing itself? Because if the entire growth story depends on state politicians suddenly deciding to be generous with rate updates, I am out. That is way too risky for my portfolio. Are the other engines, Carelon, the commercial segment, Medicare Advantage, actually strong enough to pull the weight if Medicaid stays in the trough?
And the analysts on the call pushed CFO Mark Kaye on this exact point. They wanted to know the mechanics of his confidence. And his response is essentially the core thesis of Elevance Health as an investment.
What did he say?
Management directly addressed this fear, stating that their confidence in hitting that 12% growth for 2027 is explicitly not based on a single line of business.
Meaning they aren't just relying on hope.
Exactly. They have built a highly diversified, multi-engine machine. If the state governments drag their feet and Medicaid continues to struggle with lag times, the mathematical reality is that the vertical integration of Carelon, the massive pricing power and win-backs in their commercial business, and the protected 2% margins of their reshaped Medicare Advantage portfolio are more than enough to offset the drag.
They can balance it out.
Yes. They have enough levers to pull regarding administrative cost-cutting through AI and float generation to engineer that 12% growth, regardless of what happens in any single regulatory environment.
That is exactly what an investor wants to hear. It means the ship is too wide and too well engineered to be capsized by a single rogue wave in one specific government segment.
So let's synthesize all of this. What is the ultimate bottom line for the retail investor listening to this breakdown?
Based on the transcript and all the mechanics we've explored, I think we have a very clear bull case and a very clear bear case for the stock. Let's start with the bull case. The bullish argument for Elevance Health is a story of extreme, almost fanatical financial discipline and operational control.
Yeah.
They took a painful $342 million hit to the chin to instantly resolve their lingering CMS issues, permanently clearing the runway for growth in Medicare Advantage. When they found a surprise 80-cent per share windfall in the market, they refused to let it pad their egos or artificially inflate their quarter. Instead, they plowed it directly back into AI and tech infrastructure to permanently lower their future operating costs.
And their commercial sales pipeline is exploding as corporate employers flee fragmented piecemeal care models.
Yes, and they are ruthlessly cutting the cord on unprofitable Medicaid markets like Washington, D.C. to protect their capital. They are managing this company not just to beat the next quarter, but to dominate the next decade.
That is a very compelling structural bull case. But any objective analysis must acknowledge the bear case too, because no equity is without risk.
So what's the bear case?
The bearish argument is rooted entirely in the harsh reality of the populations they actually serve. Regardless of how good their AI is, Medicaid utilization remains stubbornly high. The sickest, most vulnerable members of society are consuming more healthcare, more emergency services, and more expensive specialty drugs than ever before.
And the lag is real.
Right. While Elevance mathematically believes they can force state governments to eventually raise rates to cover these costs, relying on state politicians to continually appropriate more funding in tight budget environments is always a massive, unpredictable gamble.
And then there's OBBA.
Exactly. Furthermore, while management projects confidence that the OBBA regulations in 2027 are manageable, government implementation is rarely smooth. Any failure in their IT systems to handle the new community engagement verification processes could result in millions of members inadvertently losing coverage, which would temporarily crater their revenue and spike their administrative costs.
It is a dynamic tension, the unstoppable force of corporate efficiency meeting the immovable object of systemic medical inflation and government bureaucracy. But that is exactly what makes analyzing the healthcare sector so fascinating. You aren't just reading a sterile balance sheet. You are analyzing the behavior, the sickness, and the economic realities of American society, all translated into a language of profit and margin.
It really is the ultimate macroeconomic puzzle.
And as we wrap up this analysis of their Q2 performance, I want to leave you, the listener, with a final provocative thought to mull over regarding your portfolio, something that builds on everything we've unpacked today, but looks even further out on the horizon.
Let's hear it.
We have spent this entire deep dive talking about Elevance Health primarily as a traditional health insurance company. We talked about premium yields, medical loss ratios, risk pools, and government rate updates.
Yeah, standard insurance stuff.
But as you listen to their management talk about the mechanics of the future, as they aggressively scale predictive AI to instantly intervene in behavioral health, as they deploy Health OS to automate 80% of hospital authorizations and eliminate administrative friction, and as they build their own massive vertically integrated networks of home care nurses through Carelon, you have to ask yourself a fundamental question about how Wall Street values this company.
Which is?
At what point do we stop valuing Elevance Health as a traditional risk-pooling insurance firm that trades at a standard, boring insurance multiple and start valuing them as a massive, data-driven, vertically integrated technology platform that just happens to pay medical bills on the side?
Because if the market ever fully digests the mechanics of what Carelon and Health OS are doing and decides to reprice Elevance as a tech-enabled services company, the entire valuation paradigm for the stock changes completely.
That is the defining question for long-term holders of this equity. Thank you for joining us, and thank you for taking this deep dive into your financial future. Keep analyzing the mechanics, look past the headline numbers, and we'll see you next time.